If you're looking up finance and investing content right now, you're probably running into a lot of videos talking about inflation and how it's crashing the markets. But if you're anything like me, you're just trying to find the answers to some basic questions. What actually is inflation? How can such a small change in inflation cause such a big crash in the stock market? And what does this mean for you and your stock market portfolio? Knowing these things will definitely help you on your own investing journey right now and in the near future. And if you stick around till the end of this episode, I'll show you how you can use this info to find a ton of great companies that you can invest in with confidence. Your time is valuable, so let's get right into it, starting with what inflation actually is. Actually, let me start by saying this. If you're feeling a little embarrassed for not knowing anything about inflation, or what the CPI really is, or how it affects the stock market so much already, nobody was talking about these things just 1 year ago. Everyone was too busy watching Tesla stock hit new all-time highs almost every other day. The good old days. The important thing is that you're interested in learning and growing as an investor, which already puts you ahead of most people in the market. Don't forget that. Alright, so inflation measures the rise in prices of different goods and services. There are actually a few different kinds of inflation and many different ways to measure it. One of the most common ways to measure inflation is by looking at the CPI, which is the Consumer Price Index. This index is a weighted average of the costs of different goods and services that you and I rely on every day. Costs of things like food, energy, transportation, medical care, and so on. So if the CPI is an average of all of these costs, you can look at the change in the CPI to see if the things that you need have gotten cheaper or more expensive. Usually more expensive. Pretty straightforward, right? Well, here's the thing. The CPI is just an average. That means there are some goods and services inside the CPI that might have gone up in price, while others may have gone down. So let's look at the data together, and then I'll explain how it affects our investments. Here's a chart from the New York Times showing the monthly changes in the price of some of the everyday goods and services that we rely on. So the price of piped gas went up almost 4% from July to August. Clothing prices went up about 1.7%. Electricity went up 1.1%, cereal, baked goods, and car insurance went up roughly 1%, fruits and veggies went up 0.4%, and on down the list. Meanwhile, the price of fuel oil, airline fares, and gasoline went down a ton. So there are a couple things that I want to point out here. First, most things actually went up in price, not down. I know it sounds obvious when I say it, but my point is that life is still getting more and more expensive almost across the board, instead of just one specific category like food or energy causing the whole average to move up. Food and energy tend to be pretty volatile, so another measure of inflation that we often hear about is called core CPI. Core CPI strips out food and energy, so you end up measuring the change in costs of more specific goods like clothing and airplane tickets, and more specific services like medical services. If we take a closer look at core CPI, we'll find that this is the first time that it's gone up since March. And it actually went up quite a bit more than expected. Another thing to point out is that used cars and trucks, and even airplane tickets, are pretty big purchases that not everyone makes every year. So your life may be experiencing higher inflation than the core CPI is reporting, because your clothes and your food and your doctor's visits are still getting more expensive, but your car didn't get any cheaper. That's one of the challenges with bundling so many different things together. The third thing I want to point out is that these numbers are the changes from just July to August. They're month over month, so imagine if your piped gas got 4% more expensive every month for a whole year. That would make it 58% more expensive in just 12 months. Not 48, 58, because that 4% per month compounds. If clothing got 1.7% more expensive per month for a year, it'd be 22% more expensive next year alone. Even alcohol would be over 6% more expensive, which is basically like paying for an extra beer for every 12-pack you buy. Don't judge me. My point is that even though these numbers look small, they're not that small when you annualize them. Alright, so the CPI measures the price of everyday goods and services, and inflation is how much those prices go up over time. The next question is why these numbers have such a big impact on the stock market. And just like most things in life, the answer is that it's complicated. Don't worry, the answer really only has two parts, and I'll break them both down for you. The first part of the answer is that inflation doesn't move the markets. Expectations do. Think about your own investments. Let's just use Tesla stock as an example. Let's say that the market expects Tesla to sell 2 million cars this year, but in reality, they sell 1.8 million. Again, just an example. Their stock would absolutely crash in this situation, not because they sold 1.8 million cars, but because their sales came in 10% lower than expected. So now investors have to adjust their expectations of Tesla's future sales to account for that difference, 10% lower next year, and the year after that, and so on, until Tesla somehow closes that gap. That's a lot fewer sales over the next few years, which means a lower expected stock price today. Not just because of one little dip, but because of what that dip means when you project it out into the future. So now let's apply that same idea to inflation. It's not that inflation came in at 8.3% that is causing the market to drop. What actually happened is that analysts and economists expected inflation to come in at 8.1%, which is a little lower than last month's 8.2%. But instead of shrinking like everyone expected, inflation grew by 1/10 of a point and came in at 8.3%. So a lot of people are now adjusting their expectations for inflation in the future. And that brings us to part 2 of why such a small change in inflation can have such a big impact on the stock market. To understand that, we need to talk about the Federal Reserve. That's what's all over the news, right? Here's what you need to know as an investor. The Federal Reserve is chaired by Jerome Powell, so people use his name and the Federal Reserve pretty interchangeably. In reality, though, there's something called the Federal Open Market Committee, or FOMC. This committee meets 8 times a year, and one of the things that they do at these meetings is adjust interest rates up or down. And what does the FOMC look at to decide if interest rates should go up or down? Inflation data. Let me quickly explain how the two are connected. The Federal Reserve has 2 main goals: keep unemployment down and keep prices stable. Employment and prices are actually 2 sides of the same coin. Think about it like this. When unemployment is low and nearly everyone has a job, they have the money to buy goods and services. That means demand goes up, while supply stays pretty much the same. For example, a restaurant or a movie theater can only hold so many people, and stores only have so much inventory. So what do these businesses do when more people want what they have? They raise their prices. Remember in the beginning when I said there were multiple kinds of inflation? Well, when demand goes up but supply stays the same, that's called demand-based inflation. On the other hand, when the supply of iPhones goes down because of the chip shortage, or the supply of wheat goes down because fertilizer costs more, that's supply-side inflation. It can also be called cost-push inflation. Here's an easy way to remember cost-push. Cost-push inflation is when it costs more for these businesses to produce their goods and services, and they push those extra costs onto you. If computer chips get more expensive to make, so does the iPhone. If fertilizer gets more expensive for farmers, corn and wheat get more expensive for you and me. Those costs get pushed to us. The reason that we investors should care about demand-side inflation versus supply-side inflation is because the Federal Reserve can only really affect one of them. They can't stop the war between Russia and Ukraine, they can't stop farmers from planting fewer crops when fertilizer costs go up, and they can't stop it from getting cold outside. They can't change supply. They can only really mess with demand. And they do that by controlling interest rates. At these FOMC meetings, the Federal Reserve can raise something called the federal funds rate, which is also called the overnight lending rate. The overnight lending rate is the interest rate that banks charge each other when they borrow money from each other in the overnight market. The overnight market might sound like a true crime miniseries, but it's actually just a bunch of bankers settling up their transactions for the day by lending and borrowing money from other banks after business hours. Those loans have an interest rate, which is this overnight lending rate. So when the Federal Reserve raises the overnight lending rate, they're basically making money more expensive for banks to borrow from each other. And those costs get passed along to you and me in the form of higher interest rates on mortgages and credit cards and loans. As a result, fewer people want to borrow money, and the overall demand for houses and credit cards goes down, which causes prices to fall accordingly, which means lower inflation. When money is more expensive to borrow, individuals have less money to spend, and businesses have less money to pay people, so overall demand goes down, but unemployment starts to rise. That's how interest rates are connected to price inflation and unemployment. Don't be afraid to pause, rewind, and listen to that section again to make sure that it really clicks, because we'll need it for this next part. Alright, now that you have all that context, here's how inflation and interest rates affect stocks. That's what we're really here for. Companies that are still growing often need to raise or borrow money to build new teams and fund new projects. As we just learned, higher interest rates make it harder for companies to borrow that money. And when they can't borrow as much, they can't invest as much into building those teams and funding those projects, which means they won't grow as fast as they could have when interest rates were lower. And as we just talked about, this means you have to change your growth expectations for that company, not just this year, but next year and every year after that, because the slower growth compounds over time. Since that company won't grow as much as we expected, we should want to pay less to own a piece of it today. And so the stock price falls. But there's a real double whammy here, because rising interest rates also make bond yields rise. Bonds are safe investments, so when their yields rise, they become more attractive to investors. When that happens, stocks need to perform even more to justify buying them instead of bonds that guarantee returns. That extra risk also causes stock to go down in price. But when a company's stock price goes down, they need to sell more shares to raise the same amount of money. So it's a vicious cycle of interest rates making it harder to borrow money by taking loans, and making it harder to raise money by selling shares, which leads to slower growth, which leads to an even lower stock price, and so on. Alright, here's how you can use all this information as an investor. Like we just talked about, when the Federal Reserve sees inflation on the rise, they raise interest rates, which makes money more expensive and harder for businesses to acquire. When inflation comes in higher than expected, the market reacts by assuming the Federal Reserve will raise interest rates higher than previously expected, and stocks begin to fall accordingly. So, what kind of companies don't suffer when money gets more expensive? The answer is companies that don't need to borrow it. Those are companies with high free cash flow. Note that the company doesn't need to be profitable. They just need to be making their own money through sales to the point where they don't need to take out high interest loans or raise money by issuing a lot of new shares at low prices. Let's take a quick look at one example of one of my favorite stocks, and then I'll show you how to find more stocks like this for yourself. This is a slide from Nvidia's most recent earnings presentation. Nvidia has a free cash flow of over $8 billion last year, which is a pretty big chunk of their $26 billion in revenue. Now, that number is expected to go down in the near future, so this isn't me telling you to go run out and buy this stock. But what I am pointing out here is that they're constantly bringing in billions of dollars after all of their expenses, and as a result, they have over $20 billion in cash on their balance sheet. So Nvidia being free cash flow positive and having a huge cash balance means they don't need to raise as much money or take out as many loans as interest rates keep going up. Instead of Googling company by company and downloading every investor presentation, here's a quick way to find lots of them at once for yourself. Go to your favorite stock screener. If you don't have one, I'm a big fan of Simply Wall Street's. For this example, let's look at stocks on the NASDAQ and the New York Stock Exchange. I tend to look at industries focused on advanced technology, like semiconductors, software, communications, e-commerce, and so on, but if you care about other industries, feel free to include them in this filter. Then, the advanced filters are where we get to apply everything we've learned in this video. We're going to check the value box and only look at stocks that are cheap relative to the amount of free cash flow that they generate. The bigger the discount, the better the value. One of my favorite parts of Simply Wall Street is their snowflake system, where they show you how good a stock is based on its dividend, its value, its future growth potential, its past performance, and overall financial health. I'll just raise some of these filters a little bit to eliminate stocks with unhealthy balance sheets, stocks with low free cash flows, and stocks with poor growth prospects in the future. So here's what we should have as a result. Companies listed on major exchanges in high-tech, high-margin industries that are trading at a fair discount relative to their free cash flow while having healthy balance sheets and decent future growth prospects. That's a pretty tall order, so this should be a pretty small list. Let's check out some of the results. Microsoft, Google, Amazon, Visa, Meta Platforms, there's Nvidia, which is good to see, MasterCard, Alibaba. These are all companies with serious growth potential that aren't getting destroyed by rising interest rates today. I was actually pretty surprised to see some of the growth stocks that made the cut, companies like CrowdStrike and Block, which I talk about often. If you want to use Simply Wall Street's awesome stock screener for yourself, you can use my link in the description below or in the pinned comment to get an extended free trial and 30% off your subscription when you sign up. By the way, I make absolutely no money when you sign up. I just really like their service. Either way, hopefully this episode helped you understand what inflation is and how it's measured, why small changes in inflation can lead to big moves in the stock market, and how to apply this information in your own investing journey. Want to know which high-tech growth companies are making my shortlist right now? Check out this episode next. And if you feel I've earned it, consider hitting those like and subscribe buttons to let me know that you enjoy this kind of content. Either way, thanks for watching, and until next time, this is ticker symbol U. My name is Alex, reminding you that the best investment you can make is in you.